We're continuing our study of measuring economic performance by focusing on the three major macroeconomic variables of gross domestic product, inflation, and unemployment. From prior lessons, we've studied that gross domestic product is the final market value of all goods and services produced in a period of time. There are two ways of measuring it, the expense approach and the income approach. As noticed by this table, gross domestic product expense approach will be equal to gross domestic product income approach. The expense approach consists of adding how much money consumers spend on goods and services, how much businesses spend on capital goods, changes in inventory and construction, government spending, and exports minus imports. Whereas there are two measures of income approach. There is this measure, which is called earned income, and that corresponds to this line item, earned income, and we'll measure that on this sheet here. But there's also a total income approach, which is made up of all of these variables, which we're going to go through line item by line item. But the two approaches are equal, theoretically, but you have to make some statistical adjustments to make that happen. To understand this, we're going to do a problem where some of the data has been collected. So you have a fleet of government economists going out and collecting data, and they come back, and it's your job to make sense of it and consolidate it into the three reports. In this problem, we're given all of this data, and it is very confusing. It's not in any order, it's all mixed up, we don't know what to do with it. This is a very common problem in business. The best thing to do is to do what's called an account mapping. In an account mapping, what I've done is I've taken exactly what they've given us and put it in this very same order. So now I'm going to get rid of this. What I'm going to do is I'm going to take everything in this column that is found in the expenditure approach and put it in the expense approach column. Anything that is found in the income approach, I'm going to put in the income approach column. And anything that is found on the earned income approach, I'm going to put it in this column. Then it will be a simple task just to map the accounts into the proper table and derive the desired statistics. Let's begin. So, personal consumption expenditures. Do I see it in the expense approach? Yes, personal consumption expenditures are $245. Do I see it in the income approach? Yes, here it is, personal consumption expenditures, $245. Do I see it in the earned income approach? No. So I'll leave that blank. So it's 245 and 245. Nothing here. Net foreign factor income. Do I see it in this approach? No. Do I see it in this approach? Yes. So I'm going to put it in the income approach. I do not see it in the earned income approach. So I'll leave it blank. Transfer payments. I do not see it in the expense approach. Transfer payments, I see it here. So that's 12. I'll enter the 12 in the income approach. 12. And, I'm going to do this hit and miss, but you map it here first. So, rents. Do I see rents here? No. Do I see rents in the income approach? No. Do I see rents in the national income approach? Yes. Okay. Rents are payments to the providers of land, natural resources. Wages are payments to labor. Interest is paid to the providers of capital. And profits are paid to entrepreneurs. These are the factors of production. And that's what's going on here. We're saying that all of the output that you spend money on has to be captured as income to the people who produce that output. Wages, again, as we said just before, are payments to labor. Rents are paid to natural resources and land. So this is land / natural resources. Rents, interest is paid to capital, and profits are paid to entrepreneurs. All right. And now let's do the next line, which is rents. Not here, not here, here. So that goes into national income of 14. Consumption of fixed capital is also known as depreciation. Sadly, economists and accountants sometimes call the same thing two different words. So you have to recognize that consumption of fixed capital is also known as depreciation. Depreciation is the wearing out of something a business buys that lasts for more than 1 year. So we're looking for consumption of fixed capital. We don't see it here, but we know from the notes that gross private domestic investment is the sum of net investment plus depreciation. So if they don't give us gross investment, we know that we're going to have to add net investment to depreciation. So just in case, we're going to put 27 over here. Social Security contributions, not here. Looking down, we find them here. So we're going to put the 20 here and the 20 in that column here, the income approach. Interest, not here, not here, but we notice that interest is a payment paid to the factors of production who provide capital. So we're going to put that in the earned income approach in the last column, 13. Proprietor's income, not in the expense approach, not in the income approach. Proprietor's income is part of profits. Proprietor's income is a sub-account of profits. It's the amount of income paid to small business owners. So we're going to put that in the last column, proprietor's income of 33. Net exports, we see it here, of 11. Now, they could have given us exports of 20, for example, and imports of 9, and made us calculate this. As they're going to do with this statistic. But they just gave us the net exports number in total immediately, and you won't find it on either of the other two documents. So the 11 we're going to put here. Dividends, not on the expense approach, not on the income approach, but large corporations pay some of their profits out as dividends, and so it's part of the earned income approach or income approach. So we're going to put that, dividends, we're going to put that over here as 16. We don't see here as the income approach. We're going to leave that out. Compensation of employees is also known as wages. We don't see it here. We don't see it here. We see it over here. So we're going to put wages in the last column. $223. We're account mapping. We're taking a set of data and just mapping it to the different forms we want to put it in. Indirect business taxes. Not here. Here it is. Indirect business taxes of 18. So we're going to put that in this column. Indirect business taxes are taxes collected. It's money spent by people on goods and services, but not kept by the factors of production. So we need to include that here. All right. Undistributed corporate profits. No. Yes. Undistributed corporate profits of 21. Now, This is earned income, money earned by the four factors of production: land, labor, capital, and entrepreneurship. But just because you get paid that, just because the company makes that much money, doesn't mean you're eventually going to collect it as income, because the company may keep it to grow the company, to make the company stronger and more profitable. So we're going to put it here as a subtraction from national income before disposable income. 21. Personal taxes of 26. No? Yes. So we're going to put that in national income, 26. Corporate income taxes. No? Yes. So we're going to put that corporate income taxes here of 19, and we'll also notice that over here, corporate income taxes of 19. Corporate profits of 56. Not here, not listed on this. We're going to go over here and we'll notice the corporate profits of 56. Notice that corporate profits, when a company makes profits, it can only do three things with them. It can pay them to the government in taxes, it can pay them to the owners, or it can keep them to make the company grow larger and stronger. So these three things are going to add to 56. But it's provided on this sheet as one line. 56. Government purchases. Here it is, government purchases. So it's in the expense approach. 72. Net private domestic investment. As we learned from the notes, gross private domestic investment can be found by summing net private domestic investment and depreciation. So we're going to put 72 here. Notice they don't give us gross private domestic investment as part of the problem. So we know we're going to have to get gross by adding net and depreciation. Which is 33. Personal savings of 20. Not here. Here it is, 20. 20. So we're going to put 20 here. Okay. Now, it's going to be relatively simple to take these numbers and move them over to here, which I partially did. So let's go and complete the expense approach. We have 245 for consumption, 11 for net exports, 72 for government purchases. And we know they haven't provided this, but we know that we can get gross by adding net and domestic. So net of 33 and this of 27 gives us 60. And if we add 245, 60, 72, and 11, we've achieved gross domestic product of 388. Since we know that the expense approach is equal to the income approach, we can take that 388 and move it right over here to the income approach, because GDP income approach is equal to GDP expense approach. Now we can take the numbers in the income approach and map them to the income approach here. So we've got 245 consumption expenditures. We've got net foreign factor of 4. We've got transfer payments of 12. Social Security contributions of 20. Indirect business taxes of 18. Undistributed corporate profits of 21. Personal taxes of 26. Corporate income taxes of 19. And we've got corporate profits of 56. 56 went over here. Alright. We need depreciation, consumption of fixed capital. That was 27. That should have gone here, and that's 27. Now we can calculate our subtotals. Imagine a building filled with economists, and they all want to know something different about the economy. Yes, it's important to know the total size of our economy, gross domestic product, the total market value of goods and services produced in a period of time. But there are other economists that would want to know net domestic product. This is a statistic that tells us how large is the economy after we calculate total spending, but subtracting out how much old equipment wore out. So we're really not totally this much better off, because although we spent this much money including new equipment, some of the old equipment wore out, and that's net domestic product. And if you take 388 minus 27, you'll get 361 net domestic product. Now, there are some economists who want to know how much Americans made anywhere in the world. That's a national statistic. But there are other economists who want to know gross domestic product. How much was trade happened inside the United States, regardless of whether it's an American or a foreigner. So Nissan making cars inside the United States is domestic. General Motors making cars in China is national. So this net foreign factor income will add in General Motors in China to give us national, but subtract out Honda in Ohio, which gives us domestic. That's 4. Indirect business taxes are taxes that are collected by a business but turned over to the government. So it is included in GDP, but it is not earned income. The businessman who collects it doesn't get to keep it, so we have to subtract that out. And if we take 361 minus 4 minus 18, we'll get 339 earned income. We know now that that 339 will also be equal to the calculation of a more focused study of only national earned income of 339. This number will equal this number, national income. We converted a domestic number to a national number. Everybody in the United States, regardless of domestic or foreign, Americans anywhere in the world, excluding foreigners in our country. Different economists studying different things. Social Security contributions is a misnomer. You really don't get to voluntarily contribute this. When you get your gross pay, if you're working, you'll notice that there is a FICA tax. The FICA tax is made up of both a Social Security tax and a Medicare tax. The Social Security tax you have to pay, in this example, is 20. You'll get it in your gross pay, but you won't get it in your net pay. So we have to subtract that out. You have it, but you won't get to consume it. So we're subtracting it out. Corporate income taxes. Entrepreneurs may make a lot of money, but some of the money is going to have to be paid to the government as taxes. So although you earn it as an entrepreneur, you won't get to keep it. So we subtract that out. Undistributed corporate profits. Corporate profits are somewhat like your income. You can only do two things with your income: spend it or save it. This is the equivalent of businesses. Either they can give it to you or they can keep it to make the company grow. So undistributed profits are profits the company makes that you get as an entrepreneur, but you don't get to receive it, to spend it, because they're going to keep it to make the company grow. Undistributed corporate profits. Transfer payments are money that people who earn it get, but don't get to spend because they're taxed, and then it's given to people who don't earn it but are given it, like food stamps or public housing. And so that's 12. So we're going to add that back in. Not earned, but given to people, so it's available to spend. And if you take 339, earned income, subtract out 20, 19, 21, but add in 12, you get the amount of money that people have. Now, you have to pay taxes on this. You will notice that when you get your paycheck, your gross pay does not equal your net pay because of personal income taxes. So you take 291 minus 26 and you get 265. This is called, very important vocabulary word going forward, disposable income. This money is either consumed, spent on goods and services, or saved. Disposable income of 265, the only thing you do with your money is spend it, save it, gives you savings of 20. Notice that the money that you can spend is the same money in consumption. Why was this important to do? Suppose we're in a recession and the government wants people to spend more money. Couldn't they increase transfer payments or reduce Social Security contributions or your personal income taxes and make that grow. And by making that number grow, this will grow, and gross domestic product will grow. And we're going to talk about that in later chapters when we talk about something called fiscal policy, which is how the government regulates the economy to adjust for periods of inflation or recession. And it all starts with national income accounting, which is what we're doing here. Let's do the last variable, the theoretical equality between earned income earned by Americans, regardless of where they are in the world, by providing labor, land, capital, and entrepreneurship. And that theoretical equality between income and the expense approach. One person's expense when they spend $1 is equal to another person's income. The income approach, or earned income, is again equal to the earned income line on the total income approach. 339 will be equal to 339. So we again continue to do our account mapping. Again, a common thing for accountants to do in business. We're looking for everything in this column that will map to here. So we look for rents. Rents payable as income to the people who provide land, natural resource, of 14. Interest payable to the people who provide capital is 13. Proprietor's income that is profits but paid to small businesses, of 33. Think of this as a collection problem. You're a government economist and you're sent out to collect information, and there are all kinds of businesses, large and small. So some economists are going to capture the income of small businesses, which is relatively simple, 33. But corporate profits get split into many categories. And so as a government economist collecting data, you'll have to capture all those separate buckets to add it up into total corporate profits. So we're looking for corporate income taxes. Here it is, 19. We'll need dividends, which were provided as 16. Here it is. And undistributed corporate profits of 21 went in both buckets. And if you add 19, 16, 21, you get 56. Now, wages, compensation of employees was 223 right here. And if you add up 223, well, first of all, if you add up corporate profits and proprietors' income, large business and small business profits, you'll get 89. And if you add up 223, 14, 13, and 80 and 89 payments to the factors of production, you'll get 339. Earned income. Because people who work either as a labor, a land, capital, or entrepreneur are earning their income. That earned income is equal to this line on the earned income, on the total income line. And this is a demonstration of how the expense approach is equal to the income approach to calculate GDP, one of the three major measures of economic output.